Hi, this is Paula. I'm with the Paula Martin Group here at Keller Williams, and I am here today with Rich Berry, Pride Rock Mortgage. And so we're going to talk a little bit about financing. And so we'll make them short, just give you a little information. So Rich, when a buyer decides that they want to buy a house, they need to have a pre-approval unless they're going to be cash, right?
Yes. Yep.
And so one of the options is conventional.
Yes.
Yeah, so can you just kind of talk briefly about what a conventional loan is and how maybe it differs or why someone might use it?
Well, a conventional loan would be, a typical, say, Fannie Mae or Freddie Mac loan, and it's, a lot of times you hear the term conventional, and what that is say, it's underwritten to Fannie or Freddie's underwriting standards, and you would say put 5% down or 3% down on a conventional. You could put 20%. You could put it whatever percent you want, but if you're putting down less than 20%, you will have PMI. So it'd be some form of PMI on a conventional loan. So conventional would be also if you had a relatively good credit score, if you wanted to take advantage of the first-time home buyer programs, they each have that where you can put 3% down and the rates are pretty good. So.
Can you just talk, what's underwriting?
Well, underwriting, once we take a loan, let's say you're under contract, you have a purchase contract. We take that, we take the supporting documents, the loan application, and we send it to the lender. The lender takes the loan, puts it into underwriting. An underwriter is going to read, on a Fannie Mae or Freddie Mac loan, they're going to read the conventional guidelines. They're going to run it through the automated underwriting system, and they're just going to match up the conditions. It'll ask them to collect certain things. They'll collect those certain documents. When they collect all that, including sometimes appraisal, insurance, and title, when that all gets collected, then the loan is cleared to close. And then you can close on your loan, hopefully, way before your commitment date, and that's all there is to it.
So when you do conventional, there's a term, well, actually with a lot of different loans called PMI or MI.
Yes.
Yeah, so what are those code words for?
Well, it's private mortgage insurance is PMI, and that protects the loan. And that's, if you put down 20% on any conventional loan, you will have some form of PMI. You'll have, they call borrower paid PMI, where PMI is assigned in 5% increments. So if you put down, say, 5%, you'll have one rate of PMI. If you put down 10%, you'll have another rate. 15%, you'll have another rate. It depends how much you put down. It also depends on your credit score as well. You hear the term MI. MI stands for mortgage insurance. Government loan, FHA, USDA, any of those would have MI or mortgage insurance premium. It's because it's not a private mortgage. Fannie and Freddie are considered private mortgages.
Okay, so we can talk more about that when we're talking about the
sure.
government loans.
Yep.
So with conventional, realistically, you can go as low as?
You can go to 620 credit score on a conventional loan. What'll happen is, if you tried to put down, say, 5% of conventional, it will never happen. Even 20%, if you're gonna go to a 620 credit score, then you would have to have a relatively big down payment. But typically, if you have a credit score of, say, 670, 680 or above or something like that, then conventional might be the way to go.
And you can start as low as what, 3%?
Yes, you can put 3%
and then
down.
Put down as much more as you want.
Yep.
Yeah. So if you have any other questions about conventional loans, certainly you can go to priderockmortgage.com. You can certainly go to the Paula Martin Group. You can post any questions, certainly on our Facebook site as well. And we appreciate you listening. Stay tuned. We'll be doing some other financing questions.